Welcome, everyone, and thank you for joining us today. For those of you who don't know me, I'm Omar Leheta. I'm a financial advisor at Ferguson Financial Planning and Assante Capital Management. Just a few housekeeping items before we begin. This webinar is being recorded, and everyone watching will get the link. And because this is being hosted as a webinar, everyone attending has been muted and their videos are off. However, I do encourage everybody to post a question if you have one. You can type it into the Q&A session at the bottom of your screen. We'll try to answer it at the very end, and if we can't, I will follow up with you afterwards. As a financial advisor, my goal is to help engaged, goal-driven professionals, business owners, and families achieve financial security through strategic planning and investing. And that brings us to today's webinar topic, top themes driving today's markets. And before actually we jump into it, I wanted to ask all of you, how confident do you feel navigating today's markets with headlines such as AI, interest rates, and housing when you are making financial and investment decisions? Um, I'll post a poll because I'm interested to hear the answers of that question. I'll post a poll, and if everybody could answer that, that'd be fantastic. We'll um, we'll give it 10 to 15 seconds for people to answer the poll. So it looks like most people are somewhat confident. That's totally fair, given how fast things are changing, and hopefully today's session should help sharpen that a little bit more. I'm really excited to be joined by Christian Chiera today. Christian is a portfolio specialist for investment products at RBC Global Asset Management. He joined RBC in 2014 and is a CFA charter holder. He works alongside RBC's North American equity team, producing market content and expressing the firm's view on Canadian and US stocks. Today, Christian is going to walk us through a few topics, specifically how AI is changing business and investing, how interest rate forecasts and economic outlooks, and Canadian housing trends and long-term opportunities. We're quite fortunate to have Christian with us today to share his expertise and insights, and I know you'll find tremendous value in what he has to say. With that being said, I'm going to turn it over to Christian. Over to you, Christian.
Excellent. Hello, everybody. Thank you. Thank you so much for having me. It's a real pleasure to be here. As mentioned, so in my role, I follow the stock market every day, and this year, I myself am just somewhat confident in what's been going on. It's been unbelievably volatile. There's tons of uncertainty, both in the headlines and in the market action that's come with those headlines. So there's tons to discuss. As I say here, we're always one tweet away from prosperity, one tweet away from disaster. So we'll discuss what's been going on. But to kick things off, I like to start with this chart here, and this is a look back at the stock market over time. And the important point that I like to begin with is just the fact that we invest in stocks because the returns in the stock market are unlike what you can find elsewhere. Over since 1990, when we started this chart, the Canadian stock market's delivered 8.4% per year, which is fabulous. It's a lot better than you can get from a savings account or a government bond or relatively safe or much less volatile investments. And in fact, if you look at the last 10, 20, and 30 years, the average return for stocks is pretty similar. You call it 8.1 to 8.7%. So, the big takeaway here is when you invest in stocks, the short term is unpredictable, but the long term typically is quite repeatable. And if you put the stock market in a box, didn't look at it for 10 years, you can be fairly confident that the returns are going to be somewhere in the high single digits. But the trade-off and the reason we don't only invest in stocks is because the short term is the opposite. You rarely get 8% in a single year. Instead, you get 20%, then you get 2%, then you might get -5, and it jumps around, just averaging to 8. In fact, interestingly, if you look at the last 30 calendar years, you look at 2024, 2023, etc. Of those 30 calendar years, only one has been between 7 and 9%. So unfortunately, with stocks, you don't get the experience of this beautiful yellow line where you get a little bit of return every day. Instead, you get the blue line, which is far more volatile, and this is the trade-off with stocks. You get great returns that are essential to meet your financial plan, but day to day, month to month, there's unpredictability, and that's what makes the asset class interesting. That's also the main challenge you need to address as an investor. Now, oops, skipped ahead there. One moment, please. This is an illustration of bull markets and bear markets. Bull markets being when the stock market goes up, bear markets being when it goes down. You can see over time, you get a mix of both. Most of the time, the stock market goes up, and that's what builds to that 8% return. But occasionally we get these periods, typically associated with recession, where company earnings contract, businesses make less money. At the same time, investors become really pessimistic. There's negative headlines, and ultimately just kind of sour feelings towards businesses, and that's what causes these orange periods here, these bear markets. By the way, the terms bull market and bear market, they're named after the way that those animals attack their prey. Bulls attacking up, bears attacking down. It's us in finance, our best attempt at being creative. But the point here being, over time, there's lots of bear markets. In a financial plan, you're almost certain to encounter at least one. But the most important investing tip that I could ever give is just to exhibit resilience in these periods. These are often where a lot of investors go wrong. They sell when things are down and they miss the big recovery. In fact, if you look at investor flows over time and overlay them over this chart, what you'd find is that most investors buy high and sell low, which destroys a lot of value in the stock market. So, sticking to a plan, working with a financial advisor, it carries a lot of value when we encounter inevitably uncertain periods. Now, a lot of uncertainty this year has been driven by U.S. policy, and to try and make sense of what cannot be made sense of, the U.S. government, Trump, he comes into his seat this year with a different set of circumstances than in the past. Historically, the playbook for a Republican government is, you issue debt, you spend on growth, and ultimately, you try and keep this U.S. exceptionalism continuing and enhance the prosperity of people living in the U.S. But unfortunately, as Trump comes into office, he's faced with a predicament, and that is, the U.S. has a lot of debt already outstanding. And a lot of that debt was issued during COVID, where the US spent about double, or at least more than 1.5 times what it normally spends in order to prop up the economy. But the result is this, and you can see interest payments relative to GDP in the US is near its highs from the 90s. Interest payments in general is higher than it's ever been since we started tracking it. So this really constrains growth, because when you're spending all of your money on interest payments, that's less money that you can spend on economic growth and ultimately the welfare of your citizens as well. So if you're Trump and you want to enhance economic growth, you no longer can just keep spending and spending and you're delivering corporate tax cuts and delivering all the programs you want to deliver, because you're constrained by this debt burden. So where is he going to find the money for his big, beautiful bill? Well, there's a few ways you can raise money as a government. You can issue a new tax. Probably not the avenue that he will pursue, given it's politically very unpopular, especially for a Republican administration. But another option is spending cuts. There's tons of noise around this earlier in the year, around Elon Musk and Doge, and how much they'd be able to cut government spending. As I'll show in a second, it's actually very difficult to cut government spending if you're the U.S., given a lot of the programs U.S. spends on are difficult to cut. So, as a last measure, your third option is something like a tariff, which A tariff acts in many ways like a tax because it makes everything you want to buy as an American more expensive, but is easier to position from a political perspective as you can position it as rectifying an injustice against the US and punishing other countries, not the US itself. And ultimately, Trump has chosen this path as a means to raise the money he needs for his bill, but also in a more politically popular manner, at least in his view. Now, the reason that spending cuts are so difficult is because when you look at the breakdown of what the U.S. spends on, which is illustrated here, a lot of these things are just not easy things to stop spending on. Social Security is the biggest expense for the U.S. government, and there's really nothing they can do about that. The second biggest expense is interest payments, which is crazy. If you had told the Republican administration that they'd be spending more on interest than defense, I think most of them would be falling out of their chair. But that's the situation that we find ourselves in. And then even when you go down the list, Trump wants to make some changes to the Medicaid program, but that is a very popular program with his voter base, so it's hard to make big cuts there. Medicare, he said he's not touching. Defense, if anything, is growing. So, when you go down the list, really the only things that Trump can cut or make changes to are these small areas. Like he's proposed changes to, spending on education, spending on the environment. He wants to roll back some of Biden's, infrastructure spend, but like these are not big sources of spending for the U.S. government. So this is the challenge with making big spending cuts. Really, the area they need to cut spending is interest. And to do that, you have to spend a lot less, which ultimately won't deliver Trump's, tax cuts and ultimate growth objectives. So, really difficult predicament that the U.S. has found themselves in. Which brings us to tariffs. So Trump has made headlines really since day one, talking about tariffs. He's implemented many. You can see here the U.S. effective tariff rate on imports going back to the 1800s. And, as globalization's kind of taken hold since the early 1900s, the tariff rate in the U.S. has been in steady decline. And ultimately, the U.S. has opened its border to trade, and that's allowed them, to offshore manufacturing and import cheap goods. And ultimately, Americans have had more money in their pockets because of it. But now we've seen a big pivot. Trump is about a 15% tariff rate on average on foreign countries right now, which is it's higher than it's been since the since the Great Depression. So it's a significant change. We're really not sure yet what the ripple effects on the broader economy are going to be, but we can make some guesses based on generally how tariffs impact economies. Some of the soft data that we've seen so far, consumer and business confidence has declined. This is a composite, this black line. It's a mix of 6 different indicators that are closely tracked, illustrating consumer and business confidence. And confidence, of course, declined during the financial crisis in 2008. It troughed in 2020, when there's uncertainty around COVID. But we've seen confidence once again kind of turn negative this year as there's been a lot of uncertainty just about what U.S. economic policy is going to look like. And, as a business, you don't really know what to do, what to spend on, who to hire, where to put manufacturing when there's so much uncertainty around the level of tariffs. However, the reasons that the things we remind ourselves of reasons we still have to be invested in the U.S. Are these. Number one, U.S. businesses, they're some of the best in the world. I'm in downtown Toronto. Every office building I can see has Microsoft Office operating systems and software on them. Still more than a billion people that have iPhones. There's and everyone wants NVIDIA's AI chip. The best companies in the world in the biggest markets more often than not are in the U.S. And they're largely going to be successful. They're well-run businesses. They're likely to be successful no matter what the economic regime looks like. Furthermore, Trump, the stock market is an important scorecard for him. He's said before that He wants to front load some of the painful parts of his platform, and by next year, when he really needs votes, given he has a razor thin majority in the House, uh, likely some of his policies are going to be more market friendly, or at least that's his goal. Furthermore, the U.S. doesn't want to lose AI. I'll talk about AI in a moment, but it's perhaps the biggest, most important theme shaping the stock market right now. And then lastly, the U.S. It's a very important market if you're a global company. Still, if you're operating internationally, the market that you more often than not want to win in is the U.S. If you're a new company, the biggest source of venture capital is typically the U.S. So, there's lots of things that continue to be positives for the U.S. despite what is a lot of uncertainty. And you see that kind of sentiment shared by investors who have continued to keep a premium valuation on the U.S. stock market. So I'd wrap this up by saying there's a ton of uncertainty in the U.S. right now. The headlines are likely to remain volatile, certainly in the near term, likely for the rest of Trump's term. But that being said, the companies themselves in the U.S. are high quality, and that's the reason that while you make tweaks at the margin, it's important to remain an investor in some capacity. And one of the biggest themes, perhaps the biggest theme impacting companies right now is not Trump, it's artificial intelligence. Artificial intelligence has sent shockwaves through the stock market over the last couple of years. It's not necessarily a new thematic. You can go all the way back to 1950 when Alan Turing published the Turing test. This test where a researcher is faced with both a robot or a computer and a human and didn't know which is which and would ask questions to try and determine which is the computer. This test was thought of as necessary, back in 1950. Alan Turing you had the hypothesis that machines would become so advanced we wouldn't even recognize them from humans. And today, ChatGPT passes extremely rigorous Turing tests. So it's kind of his vision has largely come to pass. We had a first example of an autonomous vehicle in the 60s, it wasn't that impressive looking. It's kind of like a shopping cart on wheels, but it could technically navigate a classroom without human interference. In the 70s, we had the Association for the Advancement of AI founded, which is still around today. In the 90s, AI was better at chess than the greatest chess player in the world, which, again, was chess is a natural area for artificial intelligence, given it's really a series of decision trees that the human brain is going to be inferior to computer at computing. But that was a long time ago. That was almost 30 years ago that AI was that advanced. In 2002, we had robot vacuums, which technically were intelligent, but mostly were falling down the stairs and running into walls. 2011, IBM had an AI that could beat Jeopardy contestants. And then we started to see some really advanced stuff. Like 2018, Alibaba's AI could pass the Stanford reading and comprehension test. And then, 2020, OpenAI beta tested GPT-3, and 2022 is when ChatGPT came out, and that was the huge wake up call for a lot of businesses when and people like us who realized like computers can now write poetry and create art and music and speak indistinguishably from a human, and this has caused kind of every business to kind of rise to the occasion and kind of jump to act on this. An example of what AI can do today. So this picture, you probably haven't seen this exact picture before, but you know what it is because you've seen other pizza pictures in your life, and you can conclude that this is probably also pepperoni pizza. An AI just a few years ago would only be able to recognize this image if it had been trained on it, if it had seen these pixels in the exact place. But now we're at the point where AI can use what's called neural networks and ultimately act like the human brain to interpret what it's seeing. So if you've trained an AI with other pictures of pizzas, it can look at this picture and conclude that it's likely the same thing. And this it sounds like semantics, but it is an important difference between the AI of just a few years ago because it's enabled things like robotaxis. This is an example of Google's Waymo car. You might have driven in one or ridden, I should say, in one of these robotaxis if you've been to LA, San Francisco, Phoenix, Austin, or Miami. They're expanding into a few more cities quite shortly, and these are fully autonomous taxis. There's no driver. They have LiDAR and radar on the car, and then they have 14 cameras. And it's these cars are detecting what's around them. They're really impressive. They can navigate traffic, they weave in and out as a human might, and they have millions of miles on the road now, so it's pretty safe to conclude that they are safer than human drivers, although that's a little bit of a low bar depending on who you ask. But nonetheless, you know, Waymo is an example of AI in work because these cameras are detecting things that are on the road that it hasn't seen before, and that AI has largely been trained by you because Google acquired CAPTCHA back in 2009. And ever since, whenever you do one of these internet tests where you prove you're a human and not a robot buying concert tickets, uh, Google has put these street view images on there. And by selecting the motorcycle in this test, it helps train their robotaxi to know what a motorcycle looks like on the road. And that's really helped Google's Waymo car, the AI powering their cameras to be more effective. Tesla is also pursuing a robotaxi strategy. Their approach is a bit different. Lots of people have Teslas because Teslas are recording video as they're going down the road. That's being fed to Tesla, and they're using that to train their AI. So, two different approaches, but this is an area that's going to continue to garner headlines, and I think you're going to see more and more robotaxis on the road or on more roads in more cities. And it's a thoughtful implementation of artificial intelligence. Lots of other examples. This is a fun one. We had the CEO and CFO of John Deere in the office recently. Obviously not a tech company, they're a tractor company, but they've thoughtfully implemented AI in their business. They have this see and spray technology. You can bolt it onto your existing tractor, and as you're going up and down the field, instead of blanket spraying your field with herbicide, instead it uses AI to detect when you're passing over weeds and spot sprays them. So if you're a farmer, you're saving a ton of money that you would be spending on chemicals. And in fact, John Deere can charge $25,000 for this kit, and farmers get a payback of a year on average. So it's wonderful business for John Deere, great for the farmers, and a thoughtful implementation of artificial intelligence. They also have an autonomous driving kit that you can bolt on. So there's going to be lots of winners and losers in AI, and it really depends on how thoughtful you are in implementing it as it pertains to your specific business. Other examples, advertisements become super targeted. No longer are the days where Facebook just throws random ads at you. Now you get ads that are specific to your tastes. These companies know everything about you. It's not because there's a guy at Google headquarters who has a dossier with all your preferences. It's because there's an AI taking everything that you do, everything you watch, your demographics, everything they know, and feeding you ads, based on what similar people are purchasing and when they're purchasing it. So this is, why companies like Meta, who owns Facebook and Instagram, can charge much higher rates for their advertising, versus a newspaper who just sends ads to everyone, or cable television or traditional media. And again, it's due to very advanced artificial intelligence. And then, one last example, because tons of businesses are already implementing this, AI is going to really change customer service. There's a lot of help desks and customer service, applications which largely are in place to do basic troubleshooting. And in many cases, an AI can get to a solution quicker. And by hiring a computer to be your customer service agent, you save a lot of money, and ultimately you can cut down hold times and ultimately just create a better experience for customers at a lower cost. So this is low-hanging fruit for a lot of businesses, and we're not far away from a period where you're calling a company and don't even know if you're talking to an AI or a human. So how has this all been, driven? A big part of it is through big advancements in compute power. This is NVIDIA's H100 tensor chip. This was kind of the groundbreaking Ferrari of computer chips, which everyone wanted to get their hands on. NVIDIA, who makes this chip, were extremely profitable and continue to be because there's just insatiable demand. They could pay, Taiwan Semiconductor $1,000 to make this and sell it for 30, 40 grand. It's been a wonderful business, and NVIDIA's stock price has been just exploded the last few years. I mentioned 8% is kind of the long-term average return for stocks. NVIDIA's stock price has done 825% in just over 2 years, which has made the U.S. stock market look, quite bad, even though the U.S. stock market has had two of its greatest years ever as well. So, um, AI, and when I say it's a big theme, I don't mean I'm not understating it. Like it really is a big theme, and the winners so far have largely been companies like NVIDIA that have been enabling the build out of artificial intelligence for many businesses. But as an investor, we're looking at a lot of different companies. It's the John Deere's of the world that are implementing AI. It's the data centers, that are filling they're basically buildings filled with these computer chips, that companies are renting server time from to do their own AI work. There's, the infrastructure that goes into the data centers that need to be manufactured, that need complex machinery, and then the data centers themselves, they need cabling, they need power, they need cooling. So there's companies all across the supply chain that feed in some way to this AI narrative. And as an investor, these are the things that you spend a lot of time on. Moving to Canada. So in Canada, there's been different themes that have kind of been shaping the economy. Um, So in Canada, we have what's called the Bank of Canada, which is our central bank. Bank of Canada, obviously not like a bank like RBC. They don't take your money and have branches. They instead are tasked really with two things. And number one is control inflation, because runaway inflation is a problem. It erodes your savings. It ultimately causes all kinds of bad issues for your economy. And two, once inflation is under control, the role of the Bank of Canada is to support the economy. And in 2022, we were in the situation which everyone on the call would have felt, where inflation was just running out of control. This is inflation over time in Canada, and you can see we went from 2%, which is the healthy normal range that the Bank of Canada targets, quickly up to over 7%, which is quite problematic. That's when your shopping trip, instead of $100, costs $150. It's obviously a problem. A lot of this was due to immense spending during COVID. I talked about the U.S. government ramping up its spending, but we did the same here in Canada. And this really spurred a lot of activity, which combined with some supply chain constraints, created all this inflation. So the Bank of Canada stepped into action. They raised interest rates very quickly. The U.S. Federal Reserve, that's the U.S. equivalent, did the same thing. This is a look at interest rates over history, and you can see, in 2020 we were at near zero, as the Bank of Canada was very focused on supporting the economy and supporting businesses that were shut down. And almost, what felt like overnight, we were up at 5%. So, this obviously slowed down the economy. It incentivized us to save rather than spend. It made it difficult for businesses to borrow and invest. And this brought inflation down. So for the Bank of Canada, objective number one, keeping inflation under control. You can kind of put a check mark next to that, because so far, at least, it looks as though they've been able to contain inflation. But now there's questions about the economy. So objective number two is kind of in focus. Obviously, the biggest threat to the Canadian economy right now is U.S. tariffs. If this chart here shows the percentage of exports to the U.S. As a percentage of GDP. So how exposed are different countries to U.S. trade? And Canada is number three, behind Vietnam and Mexico. But you can see, so for the yellow line, that's how much the U.S. has imposed a tariff on each country. And you can see Canada has actually got off better than a lot of other countries around us. And part of the reason is our USMCA deal, which Trump has criticized, even though he negotiated it in the first place. He says he doesn't like it. And of course, he continues to implement tariffs like the steel and aluminum tariff, which directly targets Canada, given we're the biggest exporter. So, tariffs continues to be a risk. We'll see what kind of deal Trump and Carney managed to put together in this rumored 30-day negotiation. But ultimately, this remains a risk and something the Bank of Canada is watching very closely. It really depends, on what kinds of things Trump asks for as part of these negotiations. If it's a mixture of, maybe Canada spend a bit more in the military, make the Arctic a little bit more available for this Golden Dome, perhaps, that could be an exchange for lowering the tariffs. But if Trump asks for some of these other things listed here, like access to our water or our dairy industry, or other protected sectors, then the negotiations are going to be a lot more tricky, and potentially there could still be more headwinds to the Canadian economy. And if you look at Canadian businesses, obviously this uncertainty is weighing on them. This is a survey of Canadian small business confidence. This measure hit a record low just a couple months ago, surpassing even the financial crisis, and it's rebounded slightly, but still remains very depressed. So, small businesses in Canada, like they don't know what to do right now. There's so much uncertainty around, where to put your factory, who to hire, what kind of growth objectives you should be planning for. It's just a very difficult environment. And it's been reflected in Canadian employment as well, which has been soft really for 4 months in a row. Not to the point that it's recessionary or super problematic yet, but it's the kind of thing that suggests that there's early signs of weakening in the Canadian economy. So with that, the Bank of Canada has pivoted to cutting interest rates. And you can see that here from the peak of 5%, we're now at nearly half that. And this has really been in that effort to help businesses through this tough period, given inflation is in a pretty good place, and ultimately make it easy to borrow and less challenging on Canadian consumers as well. Um, so, TBD, we'll see, how much more the Bank of Canada has to cut rates and, how many more headwinds we encounter in the Canadian economy. But as of right now, the expectations is, there'll be one more rate cut this year in Canada, and two this fall in the US, which, by the way, has much higher rates. And, that's because in the US, their economy has been more resilient, and their inflation has been actually more problematic. So they've had kind of the opposite problem that we've had. So they've had to keep interest rates a bit higher. And one offshoot of that, when a country has higher interest rates, they typically also have a stronger currency. And you can see that in this chart here. So this is the USD CAD exchange rate. I've highlighted in red periods where the Canadian dollar has been really weak or really strong. Everyone on the call probably remember, the glory years post financial crisis where the Canadian dollar was above parity. You could go to the US and go on a shopping trip and come out way ahead. There's been other periods, of course, where the Canadian dollar has been very soft, below 70 cents. There's been a few instances since then, in the oil crisis in 2016, during COVID, and recently earlier this year. And typically, when the Canadian dollar is very strong, it's because we have higher interest rates in the US. We have commodity strength, given our economies tied to commodities like oil, and our economies just in general doing better than the US. These periods of weakness typically are the opposite case, where our interest rates are lower. There's fewer foreign investors wanting Canadian dollars to invest in Canada. Commodities are weak, and then the economy is not as strong as the US. And if you look at where the currency is today, it's just above 70 cents. Um, it's certainly a depressed level, and the interest rate differential fits into that. But given that we're well below the 81-cent range, over time, we're likely over the long term to revert higher rather than lower. But nonetheless, the interest rate differential, that difference between the U.S. rate and the Canadian rate, likely has to converge somewhat to ease some of that pressure. Okay, and then my last kind of topic here. I want to talk about the Canadian housing market. Housing is an important part of the Canadian economy. It's 10 to 15% of GDP. It's 40% of the bank's loan book. And for Canadians, it's still narrowly the majority of their wealth on average. So it's very important to Canadians in general. It influences our spending patterns. For a company like Canadian Tire or restaurants, all spending tends to be tied to housing. So it's an important thing to watch. The housing market's been for most of the last 20 years exceptionally strong. This is a look in black at the Canadian home price composite over time. Each of these kind of squiggly lines are different regions in Canada. Different parts of Canada have seen home price growth at different times. The prairies see strong home price growth when commodities are strong. Lately, the Maritimes has been the hottest housing market in the country. It's been also one of the most affordable. But by and large, the two areas that have seen the strongest home price growth, to no one's surprise, has been Toronto and Vancouver, with about 6% growth per year. Now, 6% doesn't sound like a lot. I'll remind you that with the power of compounding, 6% is quite a bit. Over the last 20 years, a home that was $1 million is now over 3 million. So 6% year by year doesn't sound like a lot, but the growth over time is significant. And even for the Canadian national average at 5.5, like that is much stronger than most developed countries. In fact, if you look at the US over the last 20 years has seen 3.5% growth, which is exactly the same as wage growth. So we've seen kind of wages and home prices grow in lockstep, which is a great thing for affordability. In Canada, wage growth's been similar to the US, but home prices have grown by a lot more. And this is a challenge for affordability because suddenly home prices are moving away from incomes. And the only way to support a differential like this is through taking on debt. And Canadians today have a lot more debt than Americans do. It's the reason that we've been much more sensitive to the hike in interest rates in 2022. And today you can see from this debt service ratio, more of a Canadian's income goes to debt payments than an American's, which is difficult to extend forever. So as you think about the next 20 years, 5.5% home price growth is likely to be tough to repeat, uh, given that Canadians are already much more burdened by debt than Americans are. Home prices have been through kind of a wild ride last 4 years. Coming out of COVID, we saw this extreme rally. Home prices grew by 56.7% in what was, a year and a half. Just crazy, crazy growth, 10 times the normal annual average. And then as soon as rates started rising and mortgages were no longer as affordable as they were, prices corrected. We saw about a 15% correction in the year of rate hikes. And then ever since, it's been really hard to get much volume, especially in the least affordable areas. And prices haven't really moved very much. So if you bought your home at the beginning of the pandemic, you're still up quite a bit. If you bought at the peak, you're probably down quite a bit. And if you bought over the last couple of years, your prices have been more or less flat. So really, really unusual 4 years for the housing market. And the big headwind has been this. In blue, we have the rate of expiring 5-year mortgages. And in gray, we have the rate that Canadians have been renewing at. Last year, the average rate Canadians rolled off their mortgage at was 3.1, and they rolled on at 4.9, which is an increase. Obviously, we saw the same in 2023. This year, we're seeing the same thing again. In fact, now we're seeing a lot of 2020 mortgages renew. So the average rate of a mortgage renewing is at 2.4. And so far through the year, 4.5 has been the average rate that Canadians have rolled onto. So a big increase in interest. Next year, we don't know what mortgage rates will be at yet, but the bond market is implying an even higher rate than we're at now. So this is a headwind. For much of the last 20 years, Canadians have renewed at lower rates. They've had more money and they've bought bigger houses. And this has kind of pushed the housing market higher and higher. Now we're at the point where Canadians are renewing and having to pay them at least the same, if not more, for their mortgage. And this this is a headwind because you're not thinking of buying a bigger house when you're trying to figure out how to afford your current one. So, for the housing market to really see a revival, like this is likely, we likely have to work through some of these renewing mortgages that are kind of dragging spending down. And the other thing is, your affordability is still problematic, even though home prices haven't been increasing over the last couple of years. For a new home buyer, particularly in Toronto and Vancouver, it's just a really daunting task to try and buy a home. There's a lot of numbers here, but if we walk through the Toronto column, like in Toronto, the benchmark single family home price, so excluding apartments, is 1.26 million. And at the advertised 5-year mortgage rate, 4.29, if you wanted to buy the average house, you put 20% down, you borrow 80%, your monthly mortgage payment is 54.73. And the median after-tax income in Toronto is 85,000. So if you have the average salary, you want to buy the average home, like you'd have to divert 77% of your income just to the mortgage payment, which is not sustainable. Like the rule of thumb is you should be spending more than a third of your after-tax income on your shelter. So um it's extremely difficult. What people do in Toronto is they buy condos, they get assistance from a family member, or they move outside the city. But this is obviously one of the reasons that new home buyers haven't been rushing to the housing market to prop up prices. In Vancouver, it's even more of a challenge. The average home price is $2 million. And even in like Ottawa, Montreal, Calgary, like these are cities that traditionally were quite affordable. It's more challenging at higher interest rates, certainly than it was pre-COVID. So or during COVID. So it's a difficult task. Affordability is still challenged. So these are the kinds of things that we have to work through. Obviously, supply is still constrained. There's still lots of good positive factors in the housing market, but um, of renewing mortgages and affordability continue to be the headwinds. And then last but not least, so often the question I get when you're presenting this material is, okay, should I be investing in housing, or should I be investing in traditional stocks or stocks and bonds? Um, I'm a stock guy, so I have to point out that over time stocks have won, but ultimately they're very, very different. These are very, very different investments. For one thing, if you're planning to live in one of these, housing wins. You don't want to be homeless with an amazing stock portfolio. And then there's lots of different considerations, when looking at these as investments. Housing market takes a lot more time to buy or sell a home. There's a lot of costs involved, lawyer fees, real estate agent fees, land transfer tax, carrying costs. But then you might be earning rental income. If it's your principal residence, it might be tax free. And then there's the use of leverage. People borrow money to buy stocks. They borrow money to buy housing. They typically don't to buy stocks. So there's many, many differences. But the best conclusion that I can give you is that both have been great investments over time, and likely will continue to be. If not as good as they've been, they'll likely still be great. And B, these two have had good performance at different times. In the oil crisis, 2015, 2016, stock market in Canada pulled back as most sectors were taken down by weakness in the oil patch. Housing market was resilient. Similar, or on the opposite side of the token, this past couple of years, the stock market's had a couple of the best years on record, and the housing market has been weak. So you definitely don't want to put all your eggs in one basket. Your home is typically should be considered part of your investment portfolio, but diversification is going to be your best approach when it comes to deciding on how to fund your financial goals. Okay, and with that, I'll end there. And Omar, happy to take any questions that have come in.
Yeah, that was great, Christian. Thanks for all of that information. It's definitely a lot to think about from evolving AI and how the role of it is going to be in business and investing to where interest rates and the economy are headed. Um, I know there's going to be some questions about that, so yes, I will field some of those questions. Let's start with the Canadian housing market. So. Um, it has shown long-term resilience, but now there's an affordability crisis and there's interest rate pressure. And you made a really interesting point about that the Canadian individual's debt is much higher than their US counterpart. Do you think that that the housing correction is a temporary pause, or is there a more fundamental shift in how Canadians build wealth?
Yeah, it's a great question. And there's been housing concerns in China for several years now, which I think has prompted many to
Yeah,
look at Canada and say, okay, there's going to be some of the same headwinds here. I'd argue that, we're not yet at fundamental shift, and the big reason being, the one thing that makes you very, very nervous is overbuilding when you have way too much supply and not enough demand, and that isn't a factor in Canada at this juncture, or at least not in most markets. In fact, a lot of areas that have a lot of demand for housing, it's impossible to build more, either due to
yeah,
regulatory red tape or just not enough space. So, for that reason, I'm tempted to be more in the camp of this is likely to be more of a temporary slowdown as we work through, the affordability issues, both for those renewing mortgages and those trying to get into the housing market. And I think there's going to be continued efforts from kind of all levels of government to try and um, get the housing market to a healthy point from that standpoint.
yeah.
But for now, I'm in the camp that this isn't yet a fundamental shift, and largely because there still isn't as much supply as there is demand.
Sure. Thanks for that answer, Christian. Um, when AI development began sort of accelerating, a lot of people believe that the most immediate breakthroughs are going to come in areas like self-driving cars and general automation. We haven't seen that to the extent that we've seen that the what AI has done. It's been faster and has made more tangible progress in things like text generation, image creation, um, tasks that you'd actually consider creative or artistic in nature. How do you look and where do you view the monetization of AI over the next few years? And where do you expect it to generate the most commercial value?
Yeah, there's a lot of low-hanging fruit. So yeah, I talked about some specific examples, but one of the some of the less like fun ones, but more obvious ones are like a lot of software companies are using AI to augment their software engineers. So a software engineer, instead of writing all the code for a calendar in your app, you ask, Gemini or ChatGPT to do it for you, and they spit out code, and
Yeah,
maybe it's not perfect, but it's good enough to get you most of the way there. Like these are the kinds of efficiencies that are just like easy savings for companies. So there's going to be some low-hanging fruit like that, like just using existing large language models like ChatGPT to make your workers more efficient. um, I think there's some really interesting, like complex debates now starting around monetization. Like for instance, as ChatGPT kind of replaces your Google searches, of which it's starting to do, still Google
yeah,
has way more traffic, but as we see kind of that movement, like there's fundamental questions like how do we encourage people to make websites? Because right now the model is, you and I are encouraged or motivated to make a website because if we do and it's good, people will go on Google, search for it, and then be fed ads and we'll make money. But now if someone's using ChatGPT and it's referencing a website, me as a website owner, I'm not getting paid for that, and no one's looking at the ad on my site. So, what's the motivation for me to maintain a website? So these are the kinds of things we need to figure out. Like we need to figure out some kind of system to keep that kind of payment mechanism in place to encourage content on the internet and reward people for creating useful content. Um, so with AI, there's still a lot of questions about how like what monetization is going to look like, both for content creators, human content creators, and businesses that are implementing it. But I mentioned that every company is talking about this. It's not just a tech company thing. It's I highlight the John Deere example because it really is every company. We hear insurance companies saying they're using AI to predict when you're likely to get into a car accident? Were you seeing companies that provide tax software augmenting with AI in order to make it more effective? Like there's limitless implementations, and the ones that do it properly are going to be the best performers in the stock market.
So are you saying that there's room for smaller companies to sort of thrive with the advent of AI and there's room for them to grow, or the major beneficiary is going to be companies like NVIDIA, Google, OpenAI, Meta, and those type of mega cap companies?
Um, there's definitely room for smaller companies. The challenge is going to be capex, spending. So
Yeah.
Meta, for perspective, will spend about $50 billion this year on AI, and Amazon, Meta, and Microsoft will spend about the same. 50 billion, that's like USD is more than the Canadian defense budget. So it's a massive, massive amount of money. Those four companies spending $200 billion is there's no small company that compete on that front.
Yeah.
But small companies aren't building a big data center network. Smaller companies will benefit from AI in different ways. They will either create products that make companies more efficient using AI, or they'll have a great business plan themselves that's just made better by artificial intelligence. So there's room for, yeah, certainly any company to compete. But as far as like the picks and shovels for AI, it's largely going to be the behemoths like NVIDIA, Meta, Microsoft, Amazon, and um, and Meta all kind of competing for who has the ChatGPT or large language model that everyone uses, and who has data center everyone uses, and who has a computer chip that everyone wants.
Perfect. Um, Earlier in the presentation, you touched a little bit about U.S. debt. You said, and we've continued to see the national debt in the United States grow, and they're currently still running a fiscal deficit. And in the presentation, you showed how it's quite difficult to cut government spending, and in the areas that you could cut, it's such a small part of the budget of the United States. What do you see as the long-term effect of that rising debt, and if it's left unaddressed in the U.S., and what steps should the U.S. government take actually to address that debt?
Yeah, it's really tricky because the U.S. debt has long been kind of this back page problem. Like it hasn't been like front page for the stock market at least, but it's
Yeah.
always been like lingering. It's like, okay, at some point this is going to be problematic. And now we've gotten to the point where it is problematic because um, once you're spending more on interest than nearly anything else, you have to start to make compromises. Like, when you think about like, government spending being about some things for the are for the economy, enhancing economic growth, and some things are for just the welfare of the people in your country. Um, which side of the ledger do you cut from as interest rates are rising? Because you can't just keep issuing more debt because then the problem just gets worse and worse. And COVID, I think, really accelerated, how quickly this has become a problem. The long-term effect is if you just continue on this path, eventually, holders of U.S. debt will become worried that they're not going to get their money back, and that will prompt them to ask for very high interest rates. And then, the U.S. has to pay, way more in interest because interest rates are rising, and ultimately it spirals into this, uncontrollable fiscal situation. I don't think we'll get to that. I don't think they can get to that, but that's what they have to address. And what they need to do, frankly, is stop running a fiscal deficit and start paying down debt, or at least stop taking out more debt. And that's the issue with, or the criticism from bond investors about this one big beautiful bill, is that it kind of makes worse what is already a problematic debt problem. And in Trump's mind, tariffs will fill the gap, but we don't know if that's going to be the place, especially since he's negotiating trade deals in return for taking down tariffs, like what revenue they'll get from tariffs and whether that'll offset all the spending that's taken place is really uncertain. So um, it's tough because typically, if you're in power and you run a fiscal surplus to restore debt, it means you're cutting programs that people like, and you'll get thrown out, thrown out of office. So politically, it's a bit of a pickle, to be honest. And unfortunately, it's one that the U.S. needs to address, and it's become kind of a front page thing rather than a back page thing.
I actually really like that point that you made that when the debt starts to grow, you have to make certain concessions elsewhere. It starts eating up your budget. It starts to grow and become such a substantial part of the budget that you have to cut from somewhere else, and it has to be at some point addressed. Yeah, that's a great point.
Absolutely.
Christian, thank you so much for the presentation, and thank you everybody who joined us today. I hope you found the session valuable and you walked away with some insights that can help you feel a little bit more confident in navigating today's markets. If any of the themes that we covered today sparked any questions or made you rethink your current investment approach, I'd be happy to have a one-on-one conversation with you to discuss your goals and show how strategic planning can really support them. And if you'd like to meet, you can scan the QR code on this page or reply to the follow-up email that you receive after the webinar. Thank you again, Christian, and for the information that you provided today. And we'll see everybody at the next session. Bye, everybody.
Thank you very much, everyone.